This video is sponsored by Investing.com, your #1 platform for financial information. More about them later in the video. Can you retire and solely live off the dividends from a share portfolio? If the ASX dividend yield, including franking credits, is above 5%, why would a retiree worry about withdrawal rate, whether that's 3.5% or 4%? After all, if you're living off dividends, you're not even touching your principal, right? In this video, we're going to break down this idea. Can a retiree actually live off dividends? Is this a lazy but feasible way to retire, or is it just another myth the internet loves a little bit too much? Before we go any deeper, let's break down the basics. What exactly are dividends? Think of owning a stock is like owning a small slice of a pizza shop. You're not flipping dough in the back, but you've put money into the business. Every time that shop makes a profit, say every quarter or 6 months, they might share some of that profit with the owners. That's you. That free slice of profit, that's your dividend. In the real world, dividends are usually cash payments made by companies to shareholders. They're kind of like a thank you note, but in dollars. There are a few flavors of dividends depending on what you invest in. You got these regular stock dividends. These are the most common. Big, stable companies, think banks, supermarkets, mining giants, they usually pay dividends quarterly or semi-annually. If you ever own shares in Commonwealth Bank or Telstra, you probably receive some. Then you got rate dividends. These are a bit different. Rates, real estate investment trust, own commercial properties like shopping centers or office buildings. They are legally required to pay out most of their profits to shareholders. And these dividends are often higher, but they can be more volatile and taxed differently. If you invest through ETFs like VAS, VHY, or global funds like VTI, you still earn dividends, and these ETFs collect income from the companies that they hold and pass it along to you, often every quarter. Dividends can create a steady stream of income without having to sell shares, and with Australia's franking credit system, this can be even more powerful. The idea of living off dividends is often compared to the more traditional drawdown strategy, which takes a total return approach. You withdraw a percentage of your portfolio's value, including both income and capital gains. A classic drawdown strategy is based on the 4% rule, and this rule was first introduced by a US financial advisor, William Benjamin, in a 1994 study. He found that if you withdraw 4% of your retirement portfolio each year, adjusted for inflation, your money will last about 30 years, and this was based on historical data from 1926 to 1992 and assumed a 50-50 mix of US stock and treasury bonds. So if you wanted $75,000 per year as your retirement expense, you'd need a 1.4 million portfolio. In America, where the S&P 500 makes up nearly 60% of the global share market, the dividend yield has historically ranged between 1.4% and 2%. So most US retirees rely heavily on selling assets to access their capital gains to fund their retirement lifestyle. But Australia plays by different rules, especially when it comes to dividends. The ASX currently has a trailing dividend yield about 3.77%, and when you include franking credits, about 1.46%, the total yield jumps to over 5.23%. That's more than what the 4% rule requires without needing to sell anything. And if you're in the pension phase of superannuation, that income is totally tax-free. So in theory, retiring on dividends sounds like the perfect plan. But like all things in finance, it comes with the trade-offs. Before we dive into the trade-offs, a quick thank you to today's video partner, Investing.com, which I've been using a lot lately for my own dividend research. If you ever try comparing dividend yields, payout ratios, or valuations across multiple companies, you know how time-consuming that can get. That's where their Pro Picks feature really helps. It uses AI to analyze thousands of stocks and highlights the strongest opportunities across value, income, and growth, all backed by data instead of hype. They've also just launched 4 new Australian Pro Pick strategies, so you can now explore top-ranked ASX ideas right alongside global ones and view everything in Australian dollars, which makes portfolio comparisons way easier. For example, when I open the Beat the ASX theme, it focuses on 20 outperforming stocks that have beaten the ASX 200 index. The AI model behind it is trained on over 50 financial signals to pinpoint companies most likely to outperform in the year ahead. My favorite tool inside InvestingPro is still Warren AI, an AI research assistant that breaks down the pros and cons of any stock that you ask about. I tested it with CSL, which is down more than 25% from its highs, and Warren AI's take was that CSL's 99 billion market cap and strong profitability suggests the drop is more about sentiment than fundamentals, which match my own view. They're running an extended Cyber Monday sale at the moment. You could get up to 55% off discount plus a 15% on top of that by using my link to sign up. If you want to start 2026 with a clear picture of which stocks could lead the market, check out InvestingPro through the link below. The number one trade-off is dividends aren't guaranteed. They're not contractual. Companies can cut or cancel them, and they do. BHP is Australia's second largest company. Here's how its dividends changed recently. In 2022, BHP paid out $4.63 per share, and the next year it dropped to $2.61 per share. And in 2024, it fell again to $2.21. That's over a 50% drop in 2 years. Imagine trying to plan your retirement around that. Your paycheck just got cut in half. It's not exactly a peaceful retirement when your income swings so wildly, isn't it? Dividends depend on a company's profits, and that is determined by various factors such as economic conditions, payout ratios, and management decisions. And let's not forget COVID. In 2020, around a quarter of Australian companies cut or suspended dividends altogether, and that was a wake-up call for many income investors. Having said that, there are a couple ways to deal with the swings of dividends. You can build a cash buffer, hold 6 to 24 months worth of expenses in a high interest savings account, and use this buffer in low dividend years and refill it when dividend income is strong. And diversify your dividend sources and don't rely just on banks and miners. Consider adding LICs, REITs, infrastructure, utilities, and even global diversified ETFs. Here's the next problem. Inflation. Living expenses rise each year, so if you're relying fully on dividends, those dividends need to keep up with the inflation too. Over the last 10 years, average dividend growth in Australia has been around 2.8% per year. That's just slightly above the RBA's inflation target, and recently inflation has been much higher. The challenge here, Australian companies tend to have high payout ratios, currently around 62%. Higher dividend payout means less profit goes into reinvesting back into the company, which limits growth potential and future dividend increases. There are two potential solutions for this. Number one, add dividend stocks or ETFs that are inflation linked, like REITs or infrastructure funds. Number two, tilt your portfolio toward dividend growth stocks, especially in sectors like healthcare and consumer staples, where companies often grow dividends faster than inflation. Actually, this second strategy reveals another problem of the dividend stocks in Australia, which is the third problem we're facing, which is lack of diversity. Australian market is heavily concentrated. Most dividend income comes from just a handful of sectors, mainly the big four banks, miners, and some REITs or utilities. That's a lot of eggs in very few baskets. One way to improve diversification is to add global dividend stocks or ETFs. Yes, their yields are usually lower than Australian shares, and yes, you lose the franking credits, but you gain access to more sectors and economies. But by doing that, you add in another currency risk, which can work for you or against you. Here's something that trips up a lot of income-focused investors. The higher the dividend yield, the better the investment, right? Well, not always. Chasing high dividend yields can actually lead to lower or even negative capital returns. A high income return shouldn't sacrifice the overall total returns. We just mentioned earlier, the current ASX payout ratio is around 62%, and that's high, but back in 2016, it was over 75%. In the US, it's much lower, about 24%. Why does this matter? The more profit a company pays out, the less it reinvests for future growth. Over time, that can lead to stagnant or falling share prices. Back in the early 2010s, AMP, which is an Australian financial services company, was paying a dividend yield of over 6%. But behind the scenes, the business was struggling. Bad acquisitions and market pressure. From 2015 to 2022, AMP's share price dropped from around $6.50 to under $2. Even if you reinvested the dividends, you likely have lost money overall. And this is why blindly chasing yield can be dangerous. A very high yield might not be a reward. It could be a red flag. It could signal trouble ahead or a dividend that is about to be cut. The key here is balance. Don't ignore yield. but don't make it your only goal. So can we retire on dividends? Yes, and some people do that, but it usually takes more than just chasing high yield stocks. If you got a paid off home, modest expenses, and a decent portfolio on top of your super, say 800,000 to 1.2 million, it's possible to live off dividends in Australia, especially when you factor in franking credits, manage a cash buffer, and build a well-diversified portfolio. But if you want absolute certainty, or if you're not comfortable adjusting your spending when markets dip, it might be smarter to combine a dividend strategy with a traditional drawdown total return approach. Let me know in the comments, would you rather live off dividends or follow the 4% rule? If you found this video helpful, drop a like, consider subscribe, and I'll see you in the next one.